When we're looking at borrower's qualifications during the mortgage process, we're looking at three things primarily. We're looking at credit, assets, and income. Those are the three big contributing factors to someone's qualifications as they go throughout the mortgage process. Today we're going to talk a little bit about income. Income is, beyond credit, is probably the second most important factor in qualifying for a mortgage because ultimately it dictates how much you qualify for. There are different structures of income in a way that someone can be paid. Basically, when you're a W-2'd employee of an employer or company, you're going to get paid either as a full-time hourly employee, where you're getting paid, X amount of money per hour, 40 hours a week, or whatever your full-time hourly status is. You could also be a full-time salaried employee where you're making a set amount of salary on an annual basis, broken down on a monthly basis. So that's pretty straightforward from an income standpoint for qualifying from a mortgage standpoint, just because we know exactly what your pay is going to be. We know taxes are going to be taken out. You're not a self-employed borrower, which would bring us to our next income structure. If you are a 1099 employee, you're not an employee of the company, you're basically an independent contractor. You're considered to be self-employed for all intents and purposes. When you are basically paid as a 1099 employee, no taxes are taken out. There's no deductions taken out of a pay statement for you. You're responsible for your own taxes. You also have the ability to deduct expenses, which ultimately could contribute to your bottom line qualifying income, because the lender is going to use your income after expenses are deducted. Now, there are some expenses that we can add back in, if you will, like depreciation or a certain amount of money per mile driven if it's written off in the correct space on your tax returns. But overall, the majority of your deductions are going to impact your bottom line net qualifying income. And a lot of times we do see self-employed borrowers that deduct a lot of expenses and as a result can put themselves in a position where they may not qualify or may not qualify for as much as a result. Another example of a self-employed borrower is if you own a corporation, then you're basically an employee of the corporation, but essentially you're still a self-employed borrower. You may get paid a salary with the way that your corporation's set up, but you also may, if it's an S Corp, you may get a K1, which is like a draw that you've taken over the course of a year. Lenders can use both your W-2 wages and also the K1 draws if you've got adequate history of receiving them, which is typically at least a year and very commonly can be 2 years. So if you're a self-employed borrower and you haven't been self-employed for at least a year, basically it's going to be near impossible to use your income from a qualifying standpoint, just because you don't have the adequate time of being self-employed for us to be able to use that income. Once you have 2 years of tax returns as a self-employed borrower, then you should be in the clear as far as documentation that's needed for qualifying purposes. Another thing to keep in mind, when you're an employee of a company, if you have any kind of component to your income that is variable, such as commission, bonus, overtime, things like that, you have to have an adequate history of that variable income in order for a lender to be able to use it for qualifying purposes. Usually you need 2 years of history of variable income, because 2 years of history gives us enough information to feel comfortable in our calculation for continuity of that income moving forward. We feel comfortable that it's going to continue, and we feel comfortable that based upon a history that we know what you're going to expect to make moving forward. So for all those reasons, when you're speaking with a lender about qualifying for a mortgage, it's very important that you let that lender know exactly how you're paid and all the components of your income structure, because if the lender doesn't get accurate information on the front end, they may make a determination that you qualify when you truly don't, or make a determination that you qualify for more than what you truly do. You don't want to find out halfway through the process that, due to information not being collected on the front end or any kind of miscommunication, that you don't qualify or don't qualify for the home that you're under contract to purchase. Because then essentially you've wasted your time and potentially you've lost out on money for inspections, appraisals, due diligence deposits, things of that nature. So always make sure when you're speaking with a mortgage lender at the time of application that you are truthful and clear in the income structure that you're currently operating underneath, so that there's no, nobody likes surprises unless they're good surprises, but you don't want something to come up halfway through the process that will ruin your day. So if you got any questions about income structure, and specifically anything that pertains to your situation, feel free to give us a call, reach out to us via email. We're here and always happy to help. Thanks so much.